Hello and welcome to The Rate Stuff, your essential guide to all things mortgage. I'm Jack Izzard.
And I'm Peter Stimson.
We were expecting fire and brimstone from this budget. In the event, a bit of a soggy barbecue, wouldn't you say, Peter?
It was, which is good news really. We only got a couple of property taxes in the end.
Could have been so much worse, yes. Just two taxes that directly impact property, and perhaps most crucially of all, Peter, the bond markets. They were not spooked, they haven't been running for the hills, and that matters. It's important for interest rates, isn't it?
It's important for interest rates, it's important for government borrowing. The government ran most of this up the flagpole ahead to let the bond markets know what was coming. So yes, things are pretty calm.
Okay, calm. Settle in as we unpack what the budget means for you and for the mortgage market. Okay, only one story in town for the market this week, and that is the budget. I suppose it was a classic Labour tax and spend budget, although with a slight variation, it was probably more spend and then tax, wasn't it? Because a lot of those tax rises, £26 billion in tax rises, have actually been deferred.
Yes, a lot of them are coming sort of 27, 28, even 29. So they're coming, but they're coming sort of 2 or 3 years down the road. So yes.
Yeah. Okay, so delayed pain there. Of course, in the short term, we're seeing the welfare bill go up, and that's right, the taxes are going to go up to pay for those things. But let's focus on the taxes that matter most for the property market and the mortgage market. Now, we had, in all those rumours and leaks that we've been seeing for the last weeks and months, we had been fearing the absolute worst. Capital gains tax on every single property sale, changes to stamp duty. In the end, none of that happened.
Yes.
Just a couple of things. So we got a mansion tax. They don't call it that, but that's effectively what it is. That's a new higher rate of council tax for very high value properties. So £2 million is the threshold there. That's going to hurt owners of very high end properties. Is it going to raise much money though?
No. And the government's figures say no as well. If you go into the OBR report and look at it, it's going to cause, well, 2 or 3 problems. First of all, you're going to get sort of bunching around the 2 million mark, which the OBR admit. So basically, properties are going to sort of stick at the 2 million mark and below, and also the 5 million mark. So you're going to get a reduction in stamp duty directly as a result of that. So there's, in the OBR numbers, a reduction in stamp duty. Secondly, there's going to be a problem, and we're not sure about how they're going to do this yet in terms of valuing the thing. And thirdly, you're going to get a reluctance in people to actually pay it. So whilst it only raises 400 million, and there's a question about, is it worth it to just raise 400 million? The OBR actually say there's going to be a reduction in stamp duty of around 300 million. So, for the amount of money it raises, it does beg the question as, is it actually worthwhile doing it?
Well, surely it's about posturing, isn't it? It's about showing the red wall that the rich are being taxed. I mean, let's be honest, there aren't going to be an awful lot of violins out for the owners of £2 million, £5 million houses paying a bit more council tax each year, are they? And that's going to go down very well with the kind of core constituency of the Labour Party in the north.
It does. I mean, but the question is, it does feel like a missed opportunity to me. Council tax is very much sadly in need of reform. The last revaluation of council properties, or properties, generally, was 1991. At least a quarter of them are in the wrong banding. Stamp duty is desperately in need of reform. And you talk to anybody who knows what they're talking about, it needs reform. You had the opportunity, or we need the opportunity to look at both of them together. And there was the opportunity to do that. It may have been a bit unpopular, but someone at some point needs to bite the bullet and look at stamp duty and council tax. And this just feels like a little kind of tick in the box to, playing to the gallery of the Labour Party somewhere.
Yeah, well, it's very much going to fall on the shoulders of London and the South East. That's
Absolutely.
where these high-end properties are. So there's a regional inequality question to it there. The funny thing is, as you say, it's probably not going to raise that much revenue for the Exchequer either. But it was the easier option, completely overhauling council tax, completely overhauling stamp duty, just too much hassle. And I guess the Chancellor's chosen not to do it. It's a quick fix.
It's a quick fix, but it's a quick fix that raises no money, and it's going to cause problems in the housing market.
Well,
you're going to get artificial barriers and levels at 2 million. you're going to get the point of people not wanting the house to reach 2 million in value.
So you're going to have, are you going to see people trying to make their property less valuable? So spraying graffiti on the front and leaving shopping trolleys in the front lawn to devalue the properties to get below that band.
You're going to get sort of almost those property renovation programs where they try and devalue their property almost jokingly.
Yeah.
So
no. That's so lots of unexpected consequences. And as you say, when you introduce a policy like this with thresholds, you get distortions in the market. So we'll have to watch and see how that one plays out. The other big property tax, of course, is a change in the income tax paid on revenues from properties. So landlords who earn income from their property are going to pay an extra 2% on that income tax.
Yes.
We had been talking in the recent months about the kind of buy-to-let sector sort of coming back and finding its feet again. This is going to be a real bitter blow for landlords, isn't it?
It's another sort of like nail in the coffin for landlords who hold their properties outside of company schemes, effectively. So a lot of those guys have been selling up in the last sort of 4 or 5 years. It just pushes more stuff down the company scheme route, basically. So buy-to-let market is still growing. So the death of buy-to-let has been massively over-reported. It's around about 75% of buy-to-let schemes are done through company now. It's just going to mean more and more stuff going down the company route.
Yeah,
it just makes it.
So amateur landlords just buying a property and having a go at being a landlord, that's going to be much harder now, isn't it? And you're going to see people professionalising it, if you like, and setting up a company structure to own the property.
Exactly, you pay less tax. It's much easier to hold. It's much more tax efficient to hold it in a company scheme.
Okay, so on the face of it, terrible for landlords, but actually not that many will be affected, given that so many are owning their buy-to-let properties through a company.
Yes, so new purchases, like I say, the vast majority now are going through company schemes.
Okay, all right. Well, on the face of it, sounded terrible, but not so bad in the end. And if that's the extent of it on the property tax side, well, I think we got off quite lightly. The other big question in the run-up to the budget, and I think this feeds into this leaks issue that we've had, is how the bond markets would react, because that matters. As we saw with the disastrous Liz Truss mini budget, when the bond markets turn against a government, it can be disastrous. It crushes the government in terms of their borrowing cost, doesn't it? And that, I think, was really worrying the Chancellor in the run-up to the budget.
Yeah, it's worried all governments. I mean, the government borrows, the interest on the debt is 105 billion a year. So it doesn't take much in terms of an uptick in sort of gilt rates for the government borrowing cost to suddenly go, significantly higher. And then, Rachel raised an extra 27 billion. If the bond market costs suddenly start going up, obviously her sums then start going out of kilter. She has to go back and raise more taxes. So it's essential that she kind of kept the bond markets on side. That was the reason she started leaking stuff early, try and keep the bond markets inside to stop the gilt yields going up.
So on that narrow measure, the budget was a success.
It was a success. I don't know whether she needed to leak that much that far ahead. I mean, that's obviously a wider debate.
Well, okay, now what we will do now is look at what those bond markets mean for interest rates, because the two are inherently linked. Not just the cost of government borrowing, but also the cost of borrowing for mortgage holders and mortgage borrowers. And stay with us as we unpick what it means for mortgage rates and where they go now. So steady as she goes for the bond markets, and that matters for swaps, which of course is what we care about, Peter. How have the swaps reacted to the budget?
Well, as we all know, swaps are directly related to gilts. So graph we're putting up now shows you, and basically not really any reaction at all. They've ticked down a couple of basis points, but yeah, like you say, it's steady as she goes. No real reaction.
Well, this is good news, right? We wanted a nice, no problem to see here budget,
drama.
And that's exactly what we've got. So let's look ahead to Bank of England base rate. So obviously at the start of November, the bank voted to hold rates by a very, very narrow majority, just 5 to 4. And that is a pretty clear indication that the bank is kind of itching to cut.
Yes.
Do you think it will now go ahead and do that in December?
Absolutely. So not only did the vote 5 to 4, the minutes coming out indicated a very sort of strong intent to cut interest rates.
The language dropped a lot of hints.
Absolutely. Barring an absolute disaster on CPI on the 17th, they're going to cut, absolutely.
Yeah.
So we get a cut, I think, almost certainly on the 18th of December, down to 3.75%. What's important is not so much the cut, it's going to be the vote that comes out from the Bank of England and the minutes indicating the future direction thereafter and also the speed of cuts thereafter. If you look at the swaps at the moment, 2-year is around 350, which is only indicating 2 further cuts, so down to 350. A lot of the talk out there is that Bank of England eventually settles at 325. The market is only pricing 350 at the moment.
Okay.
So it's really going to be dependent about where swaps move after that is going to be dependent on what the Bank of England kind of indicate in their minutes and the voting patterns.
Okay, so let's talk timing. So it sounds like we've pretty much nailed on a cut to 3.75% in December.
Yes.
Some debate about whether there's another 1 or another 2 cuts next year.
Yes.
Where's your best guess for that next cut after December?
Best guess will probably be February.
Okay.
Assuming inflation plays ball. So February thereafter, so down to 3.5.
Yeah, and then possibly another one down to 3.25 by what, summertime?
Yeah, the third cut, if there is one, is going to be very dependent on inflation and the general economy. But if there is one, it will probably be early midsummer, is my guess.
Okay, so there's a
But
couple.
that's a real guess at this stage.
Yeah, no, I understand, and you always get your caveats in, Peter.
Yeah.
But look, as far as I'm concerned, good news. All I want for Christmas is a base rate cut. We're
Yes.
going to get one. Hooray!
Yes, but I mean, I'd say the first 2 cuts are priced into the swap curve. So brokers out there need to be aware that it's priced into the mortgage pricing. To get the swap curve to move, to get mortgage rates to move, it's going to be dependent on what the Bank of England voting pattern looks like and what the Bank of England minutes look like.
Yes, okay, right. We've nerded out about swaps and
Yes.
Bank of England minutes and all the rest of it. Let's boil it down to what really matters, which is mortgage rates themselves. And this is where there's potentially going to be a bit of a divergence, isn't it? If we're going to see base rate notching down twice, maybe even 3 times more, do we assume that mortgage rates will automatically track down, fixed mortgage rates? Will they keep going down at the same rate?
I mean, at the moment it's priced in. So, the assumption is bank base settles at 3.5. That's priced into mortgage rates at the moment. So don't assume that, the 2 or the 5-year moves down with it. If the market thinks bank base settles at 3.25, you will get a bit of a movement down, but that's very subjective at the moment. One thing that brokers need to be aware of is there is a divergence now starting to occur, and we'll stick the graph up short again now, between the 2 and the 5-year. You can see the line sort of widening between the 2 and the 5-year. That's because as and when we hit the bottom of the interest rate curve, let's assume that's sort of mid-2026, longer term rates will rise. So obviously when you hit the bottom of the curve, the only way is up, to use the analogy of a song. So ultimately, 5-year fixed rates, the rate curve will start rising from that point. So if you are selling someone a 2-year fixed rate now, when that person comes off in 2 years' time, don't assume you're still going to be at the bottom of an interest rate curve. Rates in 2 years' time may not be at 3, bank base rate not be at 3.25 or 3.5. It may be slightly higher. You may be paying a slightly higher interest rate. Yeah. So please think about that. Yeah. If you're selling someone a 2-year versus a 5-year, so you may pay a little bit more for a 5-year now. That may be a slightly better option.
I mean, that's a key conversation that brokers will need to have with their clients as they look to fix.
We are at or near the bottom of the interest rate curve. Please bear that in mind.
Yeah. Okay. Now, another question that is potentially a little bit difficult for brokers is rate assumptions. Now, let's not assume that, much as you and I love talking about the swap rate, that the average mortgage borrower follows it in quite the same detail that we do.
Really? Okay.
Newsflash, Peter, I don't think they do. No.
Okay.
But if there is this sort of general perception that rates are going to keep coming down next year and base rate may fall to 3.5%, 3.25%, that's the sort of thing the media like to pick up on, sort of thing that people like to read in the papers. Mm-hmm. If a borrower reads that and thinks, oh, right, great, well, why aren't mortgage rates coming down as fast as that? That's a difficult one for brokers to explain, isn't it?
It is challenging. It is difficult. I get that. And it's hard. It's part of the reason brokers add value, I guess. It's part of the broker educational piece.
Yeah, but the key thing, as far as you're concerned, is we are approaching the bottom of the interest rate cycle.
So we may, you know, from a mortgage pricing point, we may even be there.
Okay, well, some salutary thoughts there, Peter. But look, hey, the budget could have been a lot worse. We are going to get a rate cut in time for Christmas.
Yep.
I count that as a win.
Yep, exactly.
I've been Jack Izzard.
I've been Peter Stimson.
You've been watching The Rate Stuff. Thank you so much for joining us. And do join us next time, where we will look ahead to what fun 2026 will bring for the mortgage market.